is Rachel Cadano, and my group mates are Lenny Jane Bunajos, Rachan May Duhig, and Justin Villena. We are from BS Accountancy 2B. We are here today to discuss about the matrix in notes payable. First, let us know the definition of notes payable. A notes payable is a promissory note is an unconditional promise in writing made by one person to another, signed by the maker, engaging to pay on demand or at fixed or determinable future time some certain in money to order or to bearer. So, this means that notes payable are crucial financial instruments that business owners may utilize to develop their organization, as well as an investment alternative. A note payable account is a financial liability in which a borrower registers a written agreement to repay the lender. When carrying out and accounting for notes payable, the maker creates liabilities by borrowing from another business and promising to return the recipient with interest. The loan is then recorded as a note due on the balance sheet by the manufacturer. Notes payable shall be recognized when a borrower registers a written agreement or promissory note to repay the lender, and either short-term or long-term business obligations represented in balance sheet. This means that payment duration for notes payable may be divided into two types, which is short-term and long-term. The short-term notes payable have 1 year maturity date, and the long-term notes payable mature in more than 1 year, but generally in 5 years or fewer. The scope is when recording notes payable includes specifying details of the matter. Information in the written statement generally includes the principal amount borrowed, the due date of the payment, and the interest to be paid. Notes payable have its own key terms. For a note payable to be valid and enforceable legal agreement, it must include the following key terms: the loan amount, the repayment dates, the interest rate, default terms, the names of both lenders and the borrowers, and the mailing address where each payment is mailed to. Because notes payable are the type of debt that must be registered in the Security and Exchange Commission and the state in which they are sold, they can give a consistent return to investors who are ready to bear the risk. But investors should be on the watch for frauds in this field.
How do we measure the notes payable? First, we need to identify the notes payable are not designated at fair value profit or loss, or notes payable designated at fair value profit or loss. We measure the notes payable initially at not designated at fair value profit or loss at fair value less transaction cost, while the designated at fair value profit or loss, we measure that at fair value. Subsequently, a not designated at fair value profit or loss, we measure at amortized cost, meaning we consider the changes, the passage of time, if there is a premium or a discount, if the present value and the face value are different, that is called amortization from one point going to another, that is called amortized cost. But the designated at fair value profit or loss subsequently measures still at fair value.
For measurement purposes, notes payable are classified into the following. So, short-term, long-term with reasonable interest rate, the long-term non-interest bearing, and long-term with unreasonable interest rate. So, in the short term, if it's initially measured at face amount, then it is subsequently measured at expected settlement amount. So if the short term is initially measured at present value, then it's subsequently measured at amortized cost. So for long term with reasonable interest rate, so if it's initially measured at face amount, so it is subsequently measured at expected settlement amount. So for the long-term non-interest bearing and long-term with unreasonable interest rate, so they are both initially measured at present value and subsequently measured at amortized cost.
Debt restructuring is a situation where the creditor, for economic or legal reasons related to the debtor's financial difficulties, grants the debtor concession that would not otherwise be granted in normal business relationship. This means that debt restructuring is a process used by companies, individuals, and even more countries to avoid the risk of defaulting on their existing debts, such as by negotiating lower interest rates. Debt restructuring provides a less expensive alternative to bankruptcy and when a debtor is financial turmoil, and it can work to benefit of both borrower and lender. Debt restructuring have three types, which are asset swap, equity swap, and modification of terms.
Asset swap, a transfer by the debtor to creditor of any assets such as real estate, inventories, receivable, investment, and many more in full payment of an obligation. So, in the word itself, asset swap, there is a swap or a transfer, which means the recent loan or borrowed by the debtor must be in cash, but unfailed to pay in cash in exchange because he or she does not have the capacity to pay. Since he or she does not have the capacity, the company will get his or her collateral, which is the property. Example of this is land, in order to collect his or her unpaid obligation. That is called asset swap. Next, there is the recognition here of liability and asset because you are going to pay your obligation. Mawala siya, that is why the recognition. And then, asset will be used also in paying your debt. Mawala sab siya, the recognition. The concept of the recognition is there may be a gain or a loss. Under U.S. General Accepted Accounting Principle or GAAP, the formula to get the gain or loss in exchange and gain or loss in extinguishment of debt is fair value of asset less carrying amount of asset is equal to gain or loss in exchange. And carrying amount of liability less fair value of asset is equal to gain or loss and extinguishment of debt. Gain or loss on exchange less and gain on loss on debt restructuring, we come up the gain or loss and extinguishment of debt under USA General Accepted Accounting Principle.
So let's go on for equity swap. So an equity swap is a transaction whereby a debtor and creditor may renegotiate the terms of a financial liability with the result that the liability is fully or partially extinguished by the debtors, issuing equity instrument to the creditor. So it was simply stated that an equity swap is the issuance of share capital by the debtor to the creditor in full or partial payment of an obligation. So, an equity swap, the debtor and creditor may renegotiate the terms of a financial liability. Yes, renegotiate or to negotiate again. Or should I say there is a changes of structure of the debt, so they have to renegotiate. The creditor and the debtor, since there is an issuance of share capital by the debtor to the creditor. So, for example, the debtor and creditor has an agreement that the debt will be paid by that day. But when due date has come, the debtor can pay the debt through money. Instead, the debtor issued a share capital to the creditor. So, the creditor and the debtor must have to renegotiate since there is an issuance of share capital. Therefore, there is an equity swap happened. So, an equity swap, there were no creditor anymore, since the creditors will become a shareholder to the debtor. So, if there is an equity swap happened, how do we value the shares issued? So, here are the measurement. First is the fair value of equity instruments issued. An entity shall measure the equity instruments at the fair value of the equity instruments issued unless the fair value cannot be reliably measured. Second, the fair value of liability extinguished. If the fair value of the equity instrument issued cannot be reliably measured, the equity instrument shall be measured to reflect the fair value of the financial liability extinguished. And the third is the carrying amount of the liability extinguished. So the difference between the carrying amount of the financial liability and the initial measurement of the equity instrument issued shall be recognized in profit or loss.
Modification of terms. It may involve either the interest concession or maturity value concession or both. So, before I differentiate the interest concession and the maturity value concession, the modification of terms is, for example, if you borrowed a money, so you have to pay also a money. So, the interest concession, it may involve a reduction of interest rate, forgiveness of unpaid interest, or moratorium of interest. So, for example, if you borrowed a money and the creditor gives you the 12% interest rate, but instead of 12%, they make you 10% na lang because the creditor makes a reduction of the interest. The maturity value concession. It may involve an extension of the maturity date or a reduction of a principal amount. So when we say extension of the maturity date is, for example, if the creditor gives you the 2 years maturity date, but instead of 2 years, they make 5 years na lang for you to fully pay the amount in paying the creditor.